Hey, this is Ken Himmler, and today we're going to talk about what Warren Buffett's opinion of the tarot card reading is. Now, before I really get into today's video, I want to explain a little bit about Warren Buffett. Over the last, say, 60 to 70 years, Warren Buffett has had an average rate of return of over 19.5%. But in recent years, Warren Buffett has clearly stated that he will probably be unable to repeat those returns going forward. He talks about the massive disparity between having a large fund and having a small fund. When you have a large fund, you might have to do a $5 billion, $100 billion, who knows how big it is with Warren Buffett's fund right now, a trade. And anytime you do that type of trade, you have to look for larger companies, you have to look for anomalies within the valuations of those companies, and they're very hard to find. The smaller the company, the easier it is to be nimble and show better returns because you don't really move markets when you have a smaller fund. The bigger it gets, the harder it is to buy something without actually moving the price of that over or up over a short period of time. So when big players like Warren Buffett go in to buy something, they generally have to do it over a longer period of time so that they're not moving the market. That over time period also diminishes the potential for their return. Now, Warren has said if you really want to try to get the best rate of return, invest in indexes. Now, if you look at the indexes in the same comparison to Warren Buffett, he's at about 19.5%, whereas the S&P 500 is about at 11.5% over that same period of time. So he is pretty close to double the S&P 500 rate of returns. But again, these anomalies are not to be followed to say I can copy what Warren Buffett does, because again, there are different skill sets and understandings and abilities for him to buy things. And in some cases, he doesn't just buy a stock. What he does is he buys companies, and then he controls what the outcome of those companies can do because he owns such a big share in those companies. So let's not anybody fool ourselves into thinking, hey, we can be Warren Buffett by following what he does. Now, when we talk about what he is referring to as the tarot card readers, let's look at that. 94.5% of all attributable returns over the last 20 years, done by a study called the Brinson-Biebauer study, attributes those returns to how you invest, not necessarily where or not necessarily when, but how you do it. Number two is only 1.5% of market returns are attributable to market timing. Having that feeling of, oh, the market's going to crash or the market's going up, the market's going down. And a lot of times people misinterpret Warren Buffett. As an example, at the time of this recording, he is holding his largest cash position since he managed money. Now, some might interpret that his crystal ball into looking towards the future and saying the world's going to come to an end, so he's going to cash. But it's not accurate because he just reinvested a big portion of that cash. So let's not try to read the tarot cards and what these self-proclaimed tarot card readers are in the market saying, hey, this is what Warren Buffett's saying is going to happen, so we do that. Now remember, only 4% of the market returns are actually attributable towards the actual selection of a single stock. 4%. The 94% is attributable to how you invest. Again, not when and not where. So let's take a look at what Warren Buffett says. Periodic setbacks will occur, but being out of the market is actually riskier than being in the market and just riding out the volatility. Now, in 2012, as an example, Buffett said he was very critical of the CEOs because they were going to cash. This is right after the 2008 financial collapse. At the same time, he invested $9.8 billion in equipment and plants. He bought all in. He has always said, I believe in America, I believe in the culture, and there's going to be ups and there's going to be downs, but that is not a prediction of the future. So what could it cost you to stay out of the market? Well, this is what I'm hearing from a lot of people. I get the comments, the emails, Ken, the market's at an all-time high. Yes, it is. Should I get out now? Should I take my money and run? And where will you run to? Because if inflation is still at 5 or 6% realistically, I don't believe the government's lie at 3%, where will you go to? Well, if you try to time the market. Here's a great example. And you looked at what would it have cost you to just be out of the market. You ready for this? 10 days, 10 of the highest market days in the last 10 years. So if you took the 10 highest growth days, which that's a very small sampling because you could be out of the market for one day and there's that one single day that the market tops out, right? It goes crazy. If you just missed the top 10 days out of, and making the presumption that the S&P 500 did 11.53%, those top days are going to cost you about 30% of your total returns, or net about 3.5% of that of the return. So if I took a $1 million investment over a 10-year period of time, just being out of the market for 10 days alone is going to cost $366,000. Now, what's the alternative to that? The alternative is you stay in the market. You have a correct, now let me clarify, strategic asset allocation plan. Not tactical. Tactical means you're moving and shaking and trying to time the market, trying to buy the best investments. Strategic simply means you have a plan where all of the asset classes are represented. Now, if you looked and said, okay, what's the conclusion of this? First, don't try to time the market. And don't fool yourself into thinking you're not a market timer. And I can tell you the characteristics of a market timer. It's funny because it's almost like dealing with some type of blockage that people have. They'll say, well, I'm not a market timer, but should I get out of the market now? I'm not a market timer. Where do you think the economy is going, Ken? Should we get out and go to cash? That's all market timing. Even though you're not buying, selling it like an active trader, the fact that you're trying to anticipate what is going to happen and you make short-term moves. Now, some of you might say, but Ken, don't you do the same thing? In a certain sense, but there's a difference between saying interest rates are going up. The Fed is absolutely saying interest rates are going up. So if interest rates are going up, I'm going to buy long-term bonds, which is what we did in November of 23. We shifted most of our short-term and intermediate terms bonds to long-term bonds. Why? As interest rates go up, if it's done in an ETF, there is a way to hedge on that interest rate increase. But this day-to-day thing of, there's a war going on, should we sell? Or, it looks to me like I read this article about putting everything into gold because the world's coming to an end. These kinds of things are just crazy. And it's never going to get you the financial stability or success that you want. So the objective is, first figure out what you want out of the money. That's the number one goal. You have to reverse engineer your actual cash flow. That's usually done through a retirement analysis, retirement plan. And what you're trying to do is you're trying to figure out what is my cash flow divided into the amount of capital that I have. Once you understand what that number is, and you understand that volatility will always be present in the markets, you can simply carve out a piece of that capital to cover a 5-year period of time. During that 5-year period of time, it allows the ups and downs and the volatility to go. I'm going to tell you a real quick story. Now, this goes back about a good 20 years ago, maybe more, because I'm old in this business. So a friend of mine, actually from Tampa, Florida, came to me, and he had just retired as a merchant marine. And his name was Mark. I won't mention his last name because we still know each other, but I'll say it's Mark. And Mark came to me with a good sizable pension plan out of the merchant marines. I would have never guessed these guys had so much in their pension plan. He was manic about the markets. Ups and downs would just completely freak him out. So we had it allocated, his portfolio was allocated into the 3-bucket strategy that I teach. But he was freaking out. He'd say, oh my gosh, it's down this, it's up this. Should I buy more? It's down this, should I sell out? So I said, here, Mark, here's what I'm going to do. We're going to split this up. And we actually physically created 3 separate accounts. The first account we titled 5-year. The second account we titled 5 to 10. And then the third account we titled 10-year. And what's interesting is I said, Mark, we're just going to ignore account number 2 and 3. All you're going to focus on is account number 1. Two and three, you don't have to worry about because it's like a CD that's maturing. It's not even going to happen for 5 years. And we drew down the cash flow from the first 5 years. After running through this little exercise, I talked to him about this was on a social side. I talked to him about a year later, and he said, it's unbelievable how just visualizing things in different buckets allowed me to sleep better at night. It reduced my stress. I didn't sit there and watch the markets every day. I didn't try to figure out what was going on with the world business news. It made a considerable difference in his happiness. And sometimes when people can't see the underlying breakdown of how things work, sometimes physically splitting it up can actually help. Actually, what we did, this is a side note, in our financial planning software that we use, our retirement planning software, typically what you'll see is these softwares that come out of these banks and brokerage houses. They break things up so you can see them into, say, small cap, mid cap, large cap, international, aggressive growth, conservative growth. It always bothered me because I could never figure out what that really meant. Like, what does that really mean to me? So what are you trying to anticipate where small caps are going and mid caps are going? That really doesn't make sense. But when we modified the software so that when people log in, they can actually see their assets allocated to three separate buckets, 0 to 5, 5 to 10, 10 plus. We got so much positive feedback because now they're actually able to visualize going, I got it. That 10-year bucket, it's going to be very volatile. It's going to go up and down all over the place. 5-year, not as much. It'll go down, up and down a little bit. So to give you some kind of benchmark, the 0 to 5 bucket might go up from maybe 1% to 3% volatility. This is on average. And the 5 to 10-year bucket may be volatile 5 to 10%, meaning you'll see it go up 5 to 10% in a year and go down 5 to 10% in a year. And the 10-year bucket, that thing will be up and down 20% at any given time. And so when you look at that, you say, okay, now I understand. I don't have to touch that 10-year bucket for 10 years. So the idea here is that if you understand how the volatility of something works, you can reverse engineer in your cash flow, figure out how much you need to put into that first 5-year bucket. This way the volatility doesn't upset you as much, because if you don't have the volatility, you'll never have the returns. If you don't have the returns, you'll never beat inflation after tax. And that's your number one goal. Okay? So the problem, I think, also occurs when people sit there and they watch. I mean, I just saw this famous author, and every month for the last 3 years, he's calling for the end of the world, and there's this little clickbait. What asset class should you put it into? And he's pumping gold, 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 gold. Well, guess what? He's not only a spokesman for a gold storage and sale company, but he owns some of that company. So you got to really watch out where some of this media comes from. Famously, Bill Ackman, the hedge fund manager, in 2020, right in the middle of the pandemic when everybody was extremely afraid, he called for a giant market crash. And guess what? He had shorted the market. So he put in, again, these figures, I'm going off 4 years of memory here, 5 years of memory, so forgive me, but basically what he did was he put something like 25 million in and he turned it into like 4 billion. It was just insane, but he moved the market because of his comments. So you have to be very, very, very careful as to who you actually listen to. And these market predictors are wrong 99.9% of the time. If they could really predict the market, why would they be telling you about it? Why wouldn't they be pulling a Bill Ackman and shorting the market? So again, this expert stuff is really, it's insane to even watch it. So if you're diversifying, the main risk that you have is volatility, not a complete wipeout. Because here's the bottom line. People talk about, well, what if the whole world comes to an end? Guess what? Stock market isn't going to matter. Gold isn't going to matter. You might have a higher premium on toilet paper and food, as we saw during the pandemic, right? That was the supply and demand human needs. Those things are more important than money at that point. So you might have things to trade. So again, when we talk about diversification, I also want to be clear, we're not talking about the number of investments. We've had people come in and ask us to do a risk assessment. and they have 100, they're dealing with a bank or a money manager, and they have 150 different investments. But when you study it, all of the investments are what's called positively correlated. Sounds like a good term, but all that means is when one is up, they're all up. When one goes down, they all go down. In a properly diversified portfolio, each asset class is represented, and you have what's called negative correlation. While that may not sound so good when it comes to portfolios, it's great because when certain things go up, the other things are going down. It gives a balancing effect. And so some people have come back to me and said, well, Ken, that doesn't make any sense. If all I have things that go up and then things that go down, how do I ever get ahead? Because over time, everything that goes up a little bit more, and then it goes down with the other things. So over time, that up and down seesaw does go up because of inflation. And as Warren Buffett says, birth rates are related to consumption. Consumption is related to demand. And then your supply will control your pricing, i.e. the secret behind Warren Buffett's magic. Hey, listen, if you're enjoying what I'm talking about, do me a favor. We're trying to narrow down the content that you want to see most. So do me a favor. If you like today's video, go ahead and hit like. That helps our ranking, which also helps production, which helps me do more of these videos for you. Lastly, if you have comments, put it in the comments because I'd like to hear really what kind of information would you like. Do you like to hear about investments? Do you like to hear about taxes? Do you like to hear about estate planning? Do you like to hear about building a business or starting a business? Those are the things that I can talk to you about, but I'd like to hear from you. So thanks for joining me this morning.